Hello everybody, this is Alan at Alan Talks FinTech. Today I want to talk to you a little bit about some lessons I've learned from investing in dividend stocks. As always, if you find this video useful, please click subscribe and you'll get my videos in the future. And also click the like button and leave some comments at the end. So some of the numbers I'll show in this presentation today are from June 29th, 2019. All right, so here's some lessons learned. Number one, foreign stocks. I had bought some Royal Dutch Shell RDSA. I knew there was an RDSB when I bought it, but I didn't really realize what the difference was. There is a difference in price, one being about a little less than $1 more expensive. So RDSA is usually about $1 cheaper or maybe a little bit less than RDSB. But there is a difference between them. RDSB is not taxed with a foreign tax. If you buy RDSA, that when you get the dividend, then you'll have to pay a foreign dividend tax, basically. So it's 15% that affects how much money you get. So what happens is both RDSA and RDSB pay the same dividend. But RDSA has a tax of 15% on the dividend, which is taken out that you'll have to pay, where RDSB, you don't have to deal with it. So I had originally bought RDSA, then I started getting dividends and out comes the tax, and I'm like, oh, I don't like that. So now I'm selling those shares and switching over to RDSB. Just something to be learned about that. Another company, Enbridge, which goes by the stock ticker ENB. It's a Canadian company, gas pipeline kind of company. And they pay their dividend in, or at least it's quoted in Canadian dollars. And they have a yield of about 6.2%, but those dividends are also taxed. The Canadian government taxes it at a 25% rate, but they have an agreement with the U.S. that it is only 15%. And then what's even better is if you hold it in a tax-deferred account like an IRA, you don't have to pay any tax. So if you're buying ENB, it's always better to hold that in a tax-deferred account, and then no taxes will be withheld. If you hold it in a taxable, like a regular brokerage account, when the dividends are paid, they'll take out taxes on that. And I've read articles where people have tried to get some taxes that they paid from the Canadian government, and they weren't really that successful, that being a U.S. investor. If you do pay taxes on these dividends to a foreign country, there is a line item on the 1040 form where you can file for credit, and depending on how much it amounts to, you can either put it directly on the 1040 or you have to file this form 1116. And then if you want to read some more about tax deferred accounts with dividend stocks or foreign dividend stocks, you can read that link that I have on this page. I'll put it in the description in the video so you can click on it and go read it. At the beginning of this year, 2019, I decided I'm going to start buying a lot more dividend stocks. And of course, there's kind of an appeal to look for the ones that are paying the most dividends. There is a problem with that, and we'll talk about that. Not something that you should cause you to avoid these things, but there's some things you should be aware of. So the first thing I've run into is some of the stocks that I bought, even before the market peaked, I bought them at a price that has since gone down. So a lot of the high dividend stocks that I bought have gone down about 5% in price over the last 6 months. Not sure why, but it seems to be a common occurrence when you look at some of these stocks, and it kind of depends what the stock is. The other thing you gotta worry about with companies like MLPs, BDCs, and REITs is they're pretty highly leveraged. They borrow a lot of money for their operations, and if the economy goes bad, then they may have to cut their dividend. So you have to kind of watch out for that. Their distributions or dividends have different tax treatments. So some of it may be taxed as normal income, and some may be taxed as dividend income. And if you aren't aware, a lot of times qualified dividends are taxed at a lower rate than non-qualified. Non-qualified is taxed at whatever your income tax rate is, where qualified dividends are much lower, taxed at a lower rate. What most people say for these high-paying dividend stocks, it's better to hold them in tax-deferred accounts. And then with unit trusts, I had bought one called BPT, British Petroleum Trust, which was a unit trust. The tax treatment of them is at best confusing. They send you a form at the end of the year called the tax booklet. And this tax booklet gives you some assistance in helping you calculate your taxes. And I did one for BPT last year, and it wasn't real easy. You had to figure out some depreciation, your cost basis, and things like that. And what you have to do with unit trusts is every time you buy a chunk of stock in that unit trust, you got to kind of track that block of stock that you bought. Sometimes they call those lots or tranches or things like that, but you basically, every time you buy stock in unit trusts, you gotta keep track of when you bought it and what price you bought it at. And what you have to do is calculate your decreasing value of the price that you paid if you hold it over a long period of time. So there's a lot more record keeping. It's quite a bit harder to figure out your taxes on unit trusts. And you'll get this booklet in the mail probably around February or March that kind of helps you calculate all this stuff. And I use TurboTax, and TurboTax connected with Fidelity because I bought this unit trust through Fidelity Investments, and most of the information was in the tax information provided by Fidelity, except this thing called depreciation. It was really confusing. If you buy them and hang on to them for several years, then you'll get better at figuring out how to do the taxes on them. But the first time you look at it, plan on spending an hour or two trying to read the tax booklet. The other thing to be aware about with unit trusts, you got to really read the various forms. There's one form called 10K that will tell you if that unit trust has a limited lifespan. So some of these trusts are set up for a certain number of years, and then when those years are up, that trust may dissolve. Or what happened with BPT is the amount of money that they would pay out on the oil that they were pumping was going to decrease over time. And if you weren't aware of that, you could be buying it thinking you're going to get a huge dividend when now it's one of these years where they decrease what pay to you. And it's spelled out in the tax booklets or in the SEC documents that they have to file. So let's take a look at some examples. So one I bought recently is called Arbor Realty, and it's a REIT, and I paid $12.90 a share because I noticed it was going up. Everybody was buying it, and now it's down to $12.12. I've lost about 6% on costs. Their current yield is about 9.24%. So if you can see in the chart that I included here, you see it was down at the end of December, started coming back up in January, and did pretty good there for a while, got up to about almost $14 a share, and has been coming down since then. And it's been coming down at the point that the rest of the stock market is going up. So this is one of those like stocks like with value investing where you really have to look at the price that you buy it at and You want to buy it at a lower price. Don't buy it at the peak. Because I think most of these stocks have very limited upside. They won't continue to grow and grow and grow. They tend to reach a peak and stay at that or actually start declining. If you go on Yahoo Finance and you look at the comments people have that own certain REITs and other like BDCs, you'll see a lot of them complaining about the stock price going down, that if they bought them years ago, they paid a much higher price. And the dividend doesn't always make up for the declining price. Just be aware of that. All right, another one that I own, and I own it in a taxable account, which is going to be painful for me when I do my taxes at the end of the year. I should really own it in a tax-deferred account like an IRA. So Energy Transfer, stock symbol ET, is a MLP, and basically MLPs, similar to REITs and BDCs, they have special tax treatments, and they also they sell you units, so your shares are considered units, and you have to really kind of track your cost basis for a company like this and keep track of it. So you'll get a tax package at the end of the year, a K1. Here's another one. I paid $14.73 per share, and the time of this video is 14.08, so I'm down over 4%, and the current yield is 8.66. But some of these companies, they gradually go down over time. So you can see the stock chart there over a year, how much it's kind of come down. So again, you got to buy these kind of companies at a low price, even though they pay a good dividend. The last one I wanted to show you was Prospect Capital, stock ticker PSEC. So it's a business development company, a BDC, and basically they provide money to they call them mid-market companies, but they also invest in other kinds of assets. PSEC pays a monthly dividend of 6 cents a share right now, and they pay it monthly. And most of the dividends are non-qualified dividends, so you're going to have to pay tax on those dividends at your ordinary income rate. So this is another type of company where it's probably better that you hold it in a tax-deferred account. That way you don't have to actually do the taxes on it every year. Right now it's $6.53 per share and paying an 11% yield, paid monthly. It's been ranging anywhere from $6.30 to $6.80 a share. This is one where you can watch the dips, and if you notice on the chart, there have been some dips where it got down close to 620. So if you were interested in that one, definitely buy the dips on it. Here's some other things to wrap up that you should be aware of. When you're buying a dividend paying stock, you got to be aware of the ex-dividend date. The ex-dividend date is the date where if you bought it on that date, you wouldn't get the dividend that was declared. You have to buy it the day before or earlier. You have to kind of watch for that. But when you buy it, it may take 5 months before you actually see a dividend, because the pay date may be a couple months out. If you buy after the ex-dividend date, then you got to wait for the next declaration of dividends, the next ex-dividend date, and then it could be, which is usually 3 months because they pay quarterly. And then some stocks, the actual pay date may be 2 months after that. So it may be 5 months before you start getting dividends. So just be aware of that. You need to pay attention to the ex-dividend date. And also be aware that after the ex-dividend date, usually the stock price goes down. In fact, the stock market automatically decreases the stock price by the dividend amount. If you're going to be a dividend investor, it's a long-term thing, not a short-term thing. And then, like I said earlier, you need to watch the prices. If you're interested in a dividend stock or high dividend stock, you need to really watch the prices and buy low, because especially the high dividend stocks, their prices typically do not increase very much at all. You're really buying it for the dividend. You're not really buying it for price growth. The the lower dividend stocks, which have a lower payout ratio, meaning um, of their earnings, they pay out a lower percentage of their earnings as dividend, where these high dividend stocks could be paying 90 to 100% of their earnings as dividends. So the high dividend stocks typically aren't growing. Those companies aren't growing and the price doesn't go up. The low priced dividend stocks, or the low yield um, yielding dividend stocks, tend to go up over time. So, like the dividend aristocrats and things like that, they usually pay anywhere from 2 to as high as 6% yield, most of them being down around 2 or 3%. They still grow a lot because they're not paying out all their earnings as dividends, which allows the company to reinvest or buy other companies or things like that, and that's where their growth comes from. Retirees like high dividend stocks because it's pretty good income. They're not really looking for price growth, where if you're younger, you may be looking for price growth and you don't need that monthly or quarterly income from dividends. And also, always make sure you reinvest your dividends unless you're actually using those dividends as income. I'm going to wrap up here. Hopefully, I helped you a little bit. I do have a website, alantalksfintech.com. I have a Twitter account, Alan Talks FinTech without the age. And then I have an Instagram page and a Pinterest page. And then, like everybody else, I have my affiliate links, which I'll put in the description of the video. And if you click on them, I get a little bit back if you sign up for some of these things. Most importantly, please subscribe to the channel, click the like button, and leave your comments. We'll talk to you next time. See ya.